Hello, my name is Matthew Deutsch, and I'm a professional business plan writer. I've been writing business plans and developing pitch decks exclusively for my clients for almost the past 20 years. It'll be 20 years this September. And I'm starting a video series just to discuss varying topics relating to the best way to go about writing a business plan, discussing different types of businesses that I've seen over the years, which tend to do very well, and also just providing general information about how to go about writing a business plan if you're doing this on your own. Today I'm going to be talking about developing the financial model for your business plan. By far, this is where most people have the most trouble, especially when they come to me if people have already started writing their own business plan. Typically, this is where the issues start. I'm always under the belief that most people can write their own pretty good business plan, especially if you're a self-financed business. It's pretty straightforward to understand how much money you're looking to raise to start a business, or how much you're going to personally invest to start the company, what the product or service you're providing, the market that you're operating in. That's all pretty straightforward. Where most people get tripped up with the financial model is that there's a lot of terminology that most people are unfamiliar with. And that's usually where the problems start. They start hearing words like contribution margin and EBITDA and depreciation and accounts receivable. This is where, if you don't have a background in accounting or finance or business administration or even economics, where this can get a little bit confusing. My first piece of advice to you, this is where you're starting to struggle, is to create an informal financial model. This is, if you can do addition and subtraction, you can kind of, figure out how to build this financial model. And it's pretty simple. Ultimately, try to estimate, whether you're selling a product or a service, how many units of this product are you going to sell every month? If you're a service-based business, let's just say you're a power washing business, how many engagements am I going to get each month, and how much am I going to charge? From there, you just do simple multiplication. If I'm, each engagement for, let's say, pressure washing is $200, I'm going to do it 50 times a month. That's going to be $10,000 in revenue. From there, you just have to discuss your underlying costs, whether you're going to have employees, your vehicle expenses. Subtract those out, and then you're left with basically your pre-tax profit. Pre-tax profit is often referred to as EBITDA, which stands for earnings before interest, tax, depreciation, and amortization, which I'll get into a little bit later in this video. But once you have that sort of informal financial model, and especially if you're a self-finance business, if you can do that on your own, and this business plan is just for you to use so you can sort of track your progress as you develop your business, that's more than sufficient. Really, the only time where you would need a full-scale formal business model is if you're approaching a potential investor, or if you're getting an SBA loan or a commercial business loan. Then you're going to want to have that formal financial model, because that's what they're going to require. Once you do have that informality, sort of, I don't say informality, but informal financial model, or sort of just, on the back of a napkin model, you can then sort of transplant those numbers into something that's a little bit more formal. Right off the bat, this is what I do day in, day out. And part of this video series is to promote my business, but also just provide general information. If you do need help with your business plan, or if you need help developing a financial model and you don't even know where to start, the name of my company is Deutsch & Thomas. You can visit the link below. Feel free to reach us at any time. Or if you have any questions just regarding this video or any content that I've discussed, feel free to put a question in the comments. I'm more than happy to answer that as well. Once you start the formal financial modeling, this is, again, where the bit of the complexity occurs. Most people can very easily understand a profit and loss statement. Again, income coming in, cost of revenue, operating expenses, profit, taxes. That's straightforward. It's really once you get into things like the cash flow analysis and the balance sheet and the break-even analysis, where things can get a little bit more complex. If you see me just looking down and just checking some notes as I go through this, very new to this. This is a new video series that I just started. And I'll be continuing to create new videos, and hopefully, our production quality will get a little bit better as time goes on. But this is just a start, so I appreciate you bearing with me. The first thing I'm going to discuss is the cash flow. Let me start with the profit and loss statement. Again, this is just going to be a reiteration, and I'll just describe the terms. Revenue, pretty straightforward. That's the money that's coming in. Right under that line, you'll often see something that says cost of goods or cost of revenue. Let's say you're a product-based business and you sell teacups. And let's say they're very nice decorative teacups and you sell them online, or you sell them through your shop. Let's say, for instance, you sell one and it has a cost of $10. Let's say that cost you $5 to buy. That would be what your cost of goods sold. So if you sold something from 10 and that product cost you 5, that's your cost of goods sold. Again, sometimes called cost of revenue. If you're a service-based business, an example of this would be, let's say you're a pressure washing company and you go to someone's house and do the service and you pull out your credit card machine and they swipe it. And let's just say that percentage is 3%. So, you rendered a $100 service, you swipe the card, $97 goes into your bank account. In that case, your cost of revenue would be 3%. The best way to think about the cost of revenue is anything that's directly tied to doing the job or selling the product. There are certain variations on this when you get into very complicated manufacturing and energy-based businesses. That's going to be a whole heap of complexity, which I'm not going to cover in this video. This is a little bit more geared towards traditional businesses that just sell products and services, and that's it. But again, cost of revenue, anything that's dedicated specifically to the cost rendering that service. In certain instances, and I typically don't do this, but let's say it cost you for that pressure washing job $5 worth of gas to get out to that guy's place to do it. In some cases, you can include that as part of your cost of revenue. Generally speaking, I keep that as an operating line just to keep things simple. But again, that can be done. One of the things I will always recommend off the bat, once you do develop your financial model, certainly bring it to a CPA. They will be able to assist you just to make any corrections or any adjustments here or there. But again, that just gives you a sense of your cost of goods or your cost of revenue. For operating expenses, these are things that are typically fixed costs or do have some variable costs. An example of this would be payroll. Again, if you own a shop that sells teacups, let's say you're employing someone, for $15 an hour, that's going to be a fixed cost. Whether someone comes in and buys your products or not, that's going to be a cost that's incurred. So that would be an operating expenditure. Same thing with rent, utilities, paying your CPA, paying your attorney. Marketing expenses are almost always put onto the operating line as well, with the exception of, let's say, commissions. If you're a commission-driven business, or let's say that salesperson, every time a product is sold, they get 5% of the sale for doing such a good job. That may go into the cost of revenue. You can also keep it as let's say a separate line on your profit and loss statement. I know I'm getting a little bit long-winded with this, I get that. But again, just trying to give as many examples as possible. Insurance costs, again, an operating expense, something that's going to be the same cost month after month, regardless of how the business is doing. Once you have that, you tally those all up, and those are your operating expenses. From there, that is your pre-tax profit, which again is also called EBITDA, earnings before interest, tax, depreciation, and amortization. If you do ultimately take out a business loan to start your business, that interest expense will be underneath EBITDA. That's not considered an operating expense, the way that, just for clarity, it's just shown sort of underneath the operating profit of the business. As it relates to depreciation, this concept, if you're completely unfamiliar with it, can seem a little bit foreign. A good example of this would be, let's say you buy a truck for your business, and let's say that truck, just going to use an easy number, is $100,000, and you put the money into your bank account, you wrote the check. In regards to how you're going to be able to deal with that from a tax standpoint, you're not going to be able to say in year one, okay, I made $100,000 worth of sales, that cost me $50,000. I had $50,000 worth of expenses, and I also bought a truck, minus $100,000. It doesn't work that way. Let's say that the way it does work is, and I'm just throwing numbers, this is just for easy math. Let's say that truck is going to have a life of 10 years. So even though you put the $100,000 up front to pay for the truck, you're only going to be able to deduct $10,000 for that truck for each year. And there are a few different ways that this is calculated, and there are things called depreciation schedules, and every last little thing has its own very specific amount of time that it can be dealt with for. But again, for the sake of easy math, $100,000 truck is going to last 10 years. On that very bottom line depreciation, you'll be able to write off, $10,000 of that for each year. Again, in real life that will vary, but just as an easy example to get an understanding of that, that's how that works. And depreciation works in your favor because it's considered a non-cash expense. So you're able to write off something that you didn't have to actually put out cash for in that year. You put the cash out first, and now you're taking that expense over a period of time. That's sort of, again, the workings of the profit and loss statement. Now we get to the cash flow analysis, and this is again where things can get a little more complicated. The cash flow analysis on the very top line will say something along the lines of cash from operations. This is the net profit of the business after taxes and after interest that is put on there plus depreciation. Because you're not, again, because in that same example where you're putting 10,000 out, or you're deducting 10,000 each year for the truck, you get to add that back. So let's just say hypothetically your profit for the year was $50,000 and you took a depreciation charge of 10,000, you get to add that 10,000 back. So now your cash flow is going to be 60,000 for that first year. As you continue to get into the cash flow analysis, the other thing that you're going to see are things like accounts receivable and accounts payable. If let's say you're a very large, again going sort of to the pressure washing business. Let's say you have a huge client and you're going to do an HOA. You're going to do all their surfaces, and that's going to be a huge contract. But because they're so big, they're not going to pay you cash immediately. They have, let's say, terms of net 30 or net 6 days, so you won't get your money for 30 to 60 days. That would be an example of a receivable. And that sort of takes away from your cash because that's not money that has come in. And accounts receivable, basically what people owe you. Same vein, accounts payable, things you owe that you have not yet paid. Now, just on a quick little side note, this is for addressing more accrual accounting based businesses. As it relates to, vast majority of small businesses work on the cash-based accounting with certain exceptions. But again, if you're opening up the two-cup shop, you're going to be working on the cash-based model almost certainly, unless your CPA for a very specific reason decides otherwise. Same deal with the pressure washing businesses. You're showing up, you're doing the job, they're paying you. So things like account receivable and accounts payable may not fully apply to your business right there and then, unless you're, again, working on that accrual model. As an example of an accounts payable, just for good measure, let's say on December 30th, you get a bill for your utility bill. Let's say it's $1,000, but you're not going to pay it until January. That would be part of your accounts payable. You're going to pay that next year, so it's going to sort of get rolled into the following year. That's ultimately how accounts payable work. If you are working, if you have taken out a business loan, the principal will be deducted from the cash flow analysis as well. A lot of people mistakenly take the entire loan amount. Let's say you borrow $100,000, and again, just an easy number. Let's say you're paying $2,500 a month for the loan, both interest and principal. The interest is deducted from your profit and loss statement because that was part of the expenses that you incurred to achieve your profit. The principal is deducted from cash flow analysis because you're paying back the actual, the physical dollars that you borrowed. That's not a deductible expense. That comes out of your cash flow. And what's left over is your cash balance for your net cash for the year and your cash balance. Whenever I do a business plan for any type of business, it doesn't matter what it is, I always do a full 5-year financial model, which includes the 5-year cash flow analysis. That way you can also show one of the other things that's deducted out of the cash flow is dividends. So if you're the owner of the business and you're taking a cash withdrawal from the profits each year, you'll see that, dividends. You may draw a salary as well as your dividends, and the dividends will come out of the cash flow analysis. And again, if there's any questions you have on this, feel free to leave a comment or just get in touch with me. I can help you out. For the balance sheet, this is also a little part that gets tricky. And most people can very easily, think of a balance sheet. It's assets minus liabilities equals the equity that you have. A very easy example of this, let's say you buy a home. Again, let's use some easy numbers that you bought that house for, say it's a really nice house. Let's say it's $1 million house and you borrowed $900,000 to buy it. You put down $100,000. Your $100,000 is your equity. The liabilities would be the $900,000 you borrowed, and the assets would be the $1 million. When it comes to a business-focused balance sheet, the little bit of complexity where people can get a little bit confused is that under assets, one of the things that you do is you add the depreciation that you incurred from the profit and loss statement each year. So returning to the discussion regarding that $100,000 truck, in year one you took a depreciation charge of $10,000, and in year two you took the same one. So on the balance sheet and under the what we call the accumulated depreciation line, it would be $10,000 in year one, $20,000 in year two, $30,000 in year three, and that's sort of the running tab of how much depreciation you have charged moving forward in each year. Again, when I do it, it's always over a 5-year model, and it just shows that total. There are a few different types of ways to do a balance sheet. Very straightforwardly, you can just take all fixed assets, your inventory, your trucks, any property you own, and just put it all in one line item. You can also segment it, which I often will do, especially if it's an inventory-based business or if there's real estate involving land. That way, the individual depreciation schedules can sort of be shown, and what's valued here. Inventory, is not really going to be depreciated because that's inventory; it's something you're selling. Whereas if you own a car or a truck, that is going to be depreciated because that's a fixed asset that you're holding for a long time. With the liabilities, if you took a business loan, that would go in there as well as any accounts payable. So if if you're going back to the cash flow analysis discussion, if you're taking that $1,000 utility bill in year 1 and it's going to be paid in year 2, that would go on there again if you're operating on the accrual system. Those are the 3 primary statements that any financial institution are going to want to see, or if any investor is going to want to see if you are looking to raise capital through an SBA loan, commercial business loan, or through private investment. Next one is the break-even analysis. This is a calculation of how much revenue needs to come in so that you exactly break even. You're not making any money, but you're not losing any money either. And the way that this calculation is done, it's your gross profit, or sometimes called the contribution margin, the percentage of that divided into your revenue. So for instance, if you, and I'm doing this in my head. So for instance, if you own that teacup shop, and let's say your monthly expenses are $10,000, and let's say on each teacup that you sell, you make 50%. So you would need to sell $20,000 worth of teacups, which cost you 10 grand, and then you have that $10,000 that would cover all your operating expenses. That's how the break even works. I need to sell this in order to cover all my operating costs. Again, not turning a profit, not taking a loss, but that's what I need to reach that break even point. And that's done, again, whatever your cost of goods or cost of revenue are, just divide that by the revenue amount, and that will give you your break even. Conversely, again, for like a service-based business, that could be somewhat a little bit more challenging because you're only going to be really having minimal expenses for providing that service. So your cost of your break even will be relatively low because you're not incurring those same costs. That's how that works. Finally, you're going to get to the business ratios, and there are a few different, and this is sort of a summation page. It's not, I always put one in just for, good measure, and so that anyone that's reviewing the plan or your financial model can have an understanding of what you're looking to do. But typically the things that are covered in business ratios are just an overview of your gross profit as a percentage, your yearly sales growth as a percentage, things like cash to assets. So you would take all the assets you have, what percentage of that is cash? You put that in there as well as a percentage. Same deal with cash to liabilities. If you took out a business loan for $100,000, but you also, let's say, put $100,000 into your business, it would be a 1-to-1 ratio. If you put in $100,000 of your own cash and borrow $50,000, it'd be a 2-to-1 ratio, and that's typically how that's denoted. Same deal with assets to liabilities. That's also another calculation that's common. Also, equity to equity as a comparison to that as well. And again, that's a little bit more of a detailed formality into any sort of business plan or financial model. There are a number of calculators out there that can assist you with that. And certainly if you work with us, if you need a business plan, that's something that we would do as a standard. That pretty much covers, the financial modeling. Some other things that you may come across is something called a common size income statement. This is a measure of what percentage of your revenue is taken up by each category. So for instance, if you have that shop that made $100,000 of revenues here, and let's say you had a part-time employee that you paid $20,000 to, then that, on the common size income statement, employee cost would be 20%. Let's say you'd say it's a simple business and insurance is only $1,000 a year, 1,000 into 100,000. Your insurance would be 1%. And this just gives you a good understanding of how your business is doing as compared to, let's say, similar businesses. And you can compare metrics to existing companies or how other startup businesses have started, just to give you a view as to how well you're doing. One other thing you may see is something called a sensitivity analysis. I always do this as a standard, but it's to show what if the business does 20% better than expected, 10% better than expected, 10% worse than expected, 20% worse than expected. And that'll give you an understanding of, and it shows basically how the business is doing as a function of your fixed operating costs. And that'll give you a sense of, again, if we do better or if we do worse, here's where our profitability will stand. And that's essentially it. For more complex businesses, such as software as a service companies, e-commerce based businesses, there are definitely much more complicated metrics that go into this. This is more just of an overview of how to deal with a, again, sort of straightforward business that works on the cash basis system with some notes about accrual. But that's pretty much, that's pretty much in a nutshell what it is. Again, this is going to be an ongoing video series that I'm creating just to help people write business plans, and certainly again as part of promoting my business. If you do need a business plan or if you need help with your financial model, certainly feel free to click the link below. You'll be taken to our website. You'll see a number of samples that we've done for business planning, financial modeling, pitch decks. All of our contact information is on there as well. And certainly if you have any questions, again, put them in the comments. I'm always happy to answer any questions. And thank you very much for taking a look. Take care and have a nice day.